Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Welcome to This Explainer. If you're handling tax strategies for businesses acquiring or leasing vehicles this year, well, you already know the drill. The depreciation limits are basically a constantly moving target. Today, we're diving straight into IRS Revenue Procedure 2026-15. We'll break down exactly what the IRS just released, look at how that new OBBA legislation impacts the numbers, and outline exactly what you need to do to keep your clients totally compliant while maximizing their tax strategy.
All right, let's just get right to the magic number. 23.468%. That is the exact automobile price inflation adjustment calculated by the IRS, and it's what drives all the new limits for 2026. Now, you might be wondering, where on earth do they get such a hyper-specific figure? Well, they actually calculate it by comparing the October 2025 Change Consumer Price Index, specifically the new vehicle component of it, against baselines from way back in 2016 and 2017. Because vehicle prices keep moving around, the IRS multiplies this 23.468% against the statutory limits in Section 280F. That gives us our fresh, rounded depreciation ceilings for the year. It's kind of funny seeing the IRS get so deep into the decimals, but ultimately, this is the mathematical engine running every single table we're about to look at. Before we get into the nitty-gritty of those limits, let's clear up a classic client misunderstanding right off the bat. The IRS definition of passenger automobiles explicitly includes trucks and vans under these specific rules. So, when your client calls you up super excited about a brand new fleet of heavy delivery vans or work trucks, you kind of have to be the bearer of bad news. You've got to remind them that for these depreciation limits and lease inclusions, they are operating under the exact same passenger automobile umbrella as a standard four-door sedan. Do not let that word automobile trick your clients into a false sense of security with their heavier vehicles.
So, here's our game plan for today. We'll cover the 2026 passenger auto depreciation limits, the OBBA bonus depreciation impact, applying owner depreciation tables, income inclusions for leased autos, and finally, practical compliance steps and traps.
Let's kick things off with Section 1, 2026 passenger auto depreciation limits. Moving right along to Section 2, the OBBA bonus depreciation impact.
Now, this new OBBA legislation is an absolute game changer. It replaces the scheduled 20% phase down with a full 100% bonus depreciation. If you remember, under the old rules, bonus depreciation was slowly phasing out, right? For property placed in service in 2026, we were scheduled to be looking at a measly 20% applicable percentage. But OBBA totally flipped the script. For qualified property acquired and placed in service after January 19, 2025, Section 168K now allows an additional first-year deduction equal to 100% of the property's adjusted basis. I mean, that is a huge win for businesses heavily investing in capital assets. But hold your horses, because as we'll see in a second, automobiles have their own strict rules that kind of put a leash on this 100% free-for-all. Here's the catch. Regardless of that massive 100% OBBA rule, Section 116K only gives a fixed $8,000 bump to the first-year auto depreciation limit. Yep, that's it. Your clients do not get to write off the entire cost of a luxury sedan in year one just because OBBA passed. The cap is a hard, flat $8,000 addition. Section 280F still enforces strict dollar caps to prevent massive upfront write-offs on luxury cars. So what the bonus depreciation rules actually do for passenger autos is simply increase that strict first-year cap by exactly $8,000. It literally doesn't matter if OBBA grants 100% bonus depreciation broadly for other equipment. For passenger autos, the bonus translates into a fixed $8,000 addition, period.
All right, Section 3, applying owner depreciation tables.
The very first hurdle you've got to clear as a CPA here is picking between Table 1 and Table 2. The IRS definitely didn't make this a one-size-fits-all scenario. Your whole depreciation schedule for a newly acquired vehicle basically hinges on whether or not the asset qualifies for that Section 168K additional first-year depreciation. Table 1 gets that $8,000 bonus bump. Table 2 does not. Nailing this initial choice is absolutely crucial to save yourself from massive headaches and costly adjustments later down the line.
So when are you stuck with Table 2, meaning zero bonus depreciation? Well, if your client falls into any of these four specific traps. First, if they use the vehicle 50% or less for business, boom, bonus is gone. Second, if they proactively elected out of Section 168K for that specific class of property. Third, if they bought a used vehicle that fails the really strict acquisition rules. Or fourth, if they've been sitting on a vehicle they acquired way back before September 28, 2017 and are just now placing it in service. If any of those are true, the bonus is gone. You have to clear these 4 gateways before you can safely lock your client into those higher limits on Table 1.
Now, this is where it gets really interesting. Notice how that $8,000 bonus difference is strictly locked into the first tax year. Years 2, 3, and everything after? Mathematically identical across both tables. Under Table 1, your first-year limit is a solid $20,300. But if your client hit one of those traps we just talked about, Table 2 restricts them to just $12,300 in Year 1. Look at how the IRS structured this. Once you get past Year 1, the schedules totally converge. Year 2 gives you a $19,800 deduction limit regardless of which table you started on. Year 3 drops to $11,900, and succeeding years level out at $7,160. So the entire tax advantage of OBBA for passenger vehicles lives and dies in that initial $8,000 first-year spread.
Moving right along to Section 4, Income Inclusions for Leased Autos.
Okay, what if they lease? For leased autos, Section 280F requires an income inclusion. Since lessees aren't claiming depreciation, they completely ignore those limits we just looked at. Instead, the tax code tries to level the playing field between buying and leasing by making lessees add a small amount back into their gross income. It's actually pretty straightforward to find. You just take the fair market value of the passenger automobile on the day the lease starts, find its bracket, and slide over to the column representing the current tax year of the lease in Table 3.
Take a look at this. Notice how incredibly fast the required income inclusion scales up as the fair market value of the lease car increases. If your client leases a $63,000 vehicle, their first-year income inclusion is just $8. Basically unnoticeable, right? But step up just one bracket to a $65,000 vehicle and that inclusion more than doubles to $19. And by the second and third years of the lease, these amounts compound even more. Now sure, these early numbers might seem like pocket change, but Table 3 goes all the way up to vehicles valued over $500,000. Up there, those income inclusions become a highly material factor in your tax calculations. It basically acts as a progressive penalty for leasing high-end luxury cars.
And finally, Section 5, Practical Compliance Steps and Traps.
To wrap things up, here is a rock-solid 4-step compliance checklist. This is going to ensure you accurately process all passenger automobiles placed in service or leased in 2026. Step 1, verify the asset classification. Don't let heavy trucks or unique vehicles slip through without making absolutely sure they meet that strict passenger auto definition. Step 2, run the vehicle through our 4-trap gauntlet to check for bonus eligibility. Did business use drop below 50%? Is it a used vehicle failing the acquisition rules? Step 3, route the purchasers to the right table. That's Table 1 for the $20,300 Year 1 limit, or Table 2 for the $12,300 limit. And Step 4, for your leasing clients, immediately lock down the vehicle's fair market value at the start of the lease and start tracking their Table 3 income inclusions year over year. Standardizing this workflow across your firm is going to save you a ton of time during busy season and totally bulletproof your files against IRS adjustments.
So, armed with all these concrete limitations and inclusion numbers, you've really got to ask yourself, how do these 2026 rules shift the optimal tax strategy for your clients' upcoming vehicle acquisitions? With OBBA handing out massive bonus depreciation broadly, but Section 280F keeping a tight leash on autos, the old lease versus buy math has seriously changed this year. Is that $20,300 first-year cap going to push your clients toward heavier, non-passenger vehicles? Or does the relatively tiny income inclusion on mid-tier leased vehicles make leasing the better cash flow play? The numbers are locked in. Now it's time for you to do what you do best and advise. Thanks so much for joining me on this explainer, and we will see you next time.